There is no shortage of private capital in the world today. Global ESG assets are measured in the tens of trillions of dollars. Pension funds, insurers, sovereign wealth funds all have capital looking for opportunities. So why isn't more of that money flowing into developing markets? Most people assume the answer is lack of interest. But that's not really the issue. The issue is loss. More specifically, the fear of sudden, severe, hard-to-control loss. When investors are asked what holds them back from investing in developing markets, many concerns appear on the list. But two consistently dominate: political risk and currency risk. What's interesting is these risks are often discussed as though catastrophic outcomes are common. In reality, major political or currency events are usually quite rare and often isolated. But when they do happen, they can wipe out years of profitable returns almost overnight. And that's what investors remember. We sometimes call this the monster under the bed problem. The actual probability may be low, but the perceived consequence is enormous, and at the end of the day, finance is still a people business. Perception influences behavior. That's an important lens through which to view many blended finance solutions. Tools such as political risk mitigation, guarantees, insurance, and other forms of risk sharing are often designed to address this fear of catastrophic loss. Not because disaster is expected, but because confidence changes investment behavior. Currency risk presents an even bigger challenge. Traditional foreign exchange hedging tools can work reasonably well for loans and fixed income products, where future cash flows are relatively predictable. But many developing markets are already heavily indebted. What they often need is more equity capital, not more debt. And that's where things get difficult. Private equity cash flows are uncertain by nature. Investors don't know exactly when they will invest, exit, or receive distributions. As a result, many conventional hedging tools don't translate easily into private equity investments. And that helps explain why currency risk remains one of the biggest barriers to mobilizing more private capital into developing markets. The good news: these challenges are not impossible to solve. In our next video, we'll explore political risk and why it may be more manageable than many investors think. Then we'll tackle foreign exchange risk, one of the toughest and most important challenges in development finance today. Stay tuned.